Hi everyone, my name is Rishit. Today is the 16th of January 2024 and I'm going to be going over an introduction to option chains, which is the sixth lesson in my series of introduction to options. So what is an option chain? An option chain can be defined as the listing of all option contracts. It shows all listed puts, calls, their expiration, strike prices, and volume, along with pricing information for a single underlying asset within a given maturity period. The chain will typically be categorized by expiration date and segmented by calls versus puts. And obviously there's many option chains for any single underlying security or asset because there are many expiry dates, and you will get different option chains for different expiry dates. So now that we have the basic understanding of what an options chain is, what are the parts of an option chain? There are 4 columns of information that traders focus on to assess the current market conditions. These columns are the last price, net change, bid, and ask. The last price column displays the latest trade price captured and reported. In other words, the premium that the option sellers and buyers can look at for an underlying strike price. The information in the net change column reflects the change in direction, up, down, or flat, for the underlying asset, as well as the amount of price variance from the previous trade. Review of the bid column shows information about how much a trader could expect to receive on the sale of the option at that time frame. Information about how much the trader can expect to pay to purchase that option at that time appears in the ask column. Trading volume, or the number of contracts that change hands in a given day, indicates how much liquidity there might be for any given option. Open interest, meanwhile, measures the total number of options outstanding on each strike and maturity, allowing you to gauge the scale of market commitment, along with understanding valid and strong or weak support and resistances. Strike price. Now, this is a word that comes up quite often. It's the price at which the holder of an option can exercise the option to buy or sell the underlying security. Additionally, we also see on some option chains implied volatility, which is the market's forecast of a likely movement in a security's price. It's a metric used by investors to estimate future fluctuations, volatility in other words, of a security's price based on certain predictive factors. Historical volatility is also seen quite often on option chains, which is the average deviation from the average price of a security, expressed as a percentage, and is useful when comparing it with other stocks or indices, or even just with previous number values of the same underlying asset. For example, if a historical volatility 2 days ago was at 10% and it goes up to 15%, that means the volatility has increased for the stock. Finally, almost every option chain will have the put-call ratio. Now, this is one of the most important parts of the option chain. It's the total number of sold puts divided by the total number of sold calls. So this shows market sentiment and even overbought, oversold conditions. So a perfect ratio is 1, where the number of puts and calls being sold are exactly the same. But obviously this is very rarely the case, and there's fluctuations where you can gauge whether the sentiment is more bullish or bearish. So from this is the end of my video, and obviously thank you for watching. Enjoy, and I will see you next time.